Central bank meetings occur 8 times a year, at least in the United States, and for most of the last decade, very little has happened that small businesses need to be concerned about since interest rates have been kept at historic lows since the financial crisis of 2008. However, there is probably no better time to pay closer attention to the news cycle than now. Interest rates have risen as central banks worldwide attempt to contain inflation, and many economists predict that they will rise further and stay elevated for the next 12 to 18 months. The higher interest rates, of course, mean higher borrowing costs for both businesses and individuals. Hello and welcome back to the Finance Guardian channel. Do you know what this means for you, your debt repayments, and your cash flow? In this video, we'll be talking about these crazy high interest rates, free cash flow, and more. So hit that subscribe button and the bell beside it, and let's get started. Inflation in the United States stands at a 40-year high, and despite recent rate hikes, a technique widely employed by policymakers to reduce inflationary pressure, there's likely to be many more hikes to come. Several sources suggest that interest rates, also known as the federal funds rate, may stay above 4% until at least the end of 2023. Interest rates are currently set between 4.25% and 4.5%, driving borrowing costs to their highest level since 2007. This was the 7th consecutive rate hike following 4 straight increases of 3/4 points. If you don't follow this news regularly, it might not seem like a big deal, but moves like this aren't something that happens very often. In fact, before this year, no 0.75 pp increase has occurred since 1994. Value investments have historically outperformed their growth counterparts in rising rate environments. Many market participants have enjoyed the recent surge of high-flying growth stocks, particularly in the technology sector. However, investors should ask themselves whether the balance sheets of these companies will be sufficient for them to survive and thrive in an environment where interest rates are rising. Switching from growth to value. The question can be answered by examining the US market in recent months. There has been a shift in sentiment towards companies with strong cash flows as value stocks have outperformed growth stocks. This is partly the result of attractively valued companies, resilience in periods of higher inflation, and rising interest rates. Considering the possibility of greater volatility this coming year, it might be a good time to switch from growth to value. But what makes one particular value strategy more attractive than another? Focus on free cash flow. Investing in value stocks can be done in a variety of ways. The results can be different if you choose to use the traditional price-to-book approach or a more complex quantitative approach. But the cash flow metric and free cash flow stand out in the current environment. Investors must understand both tangible and intangible assets to understand a company's true value and find investment opportunities in 2022. Knowing a company's free cash flow can help with this. Historically, companies that generate high free cash flow outperform other value stocks in a rising rate environment. One of the most important financial metrics to consider when investing in value names is free cash flow. This is particularly relevant for buy and hold investors. A company's free cash flow can be calculated by subtracting its capital expenditures from its cash flow, which includes taxes, expenses, interest, and long-term investments. With this figure, investors are given a holistic picture of their remaining cash, excluding many assumptions, and referring to the cash in hand left over after all bills have been paid. When an investor understands how to calculate a company's cash flow, he or she will be able to correlate the value of the company with the company's ability to withstand external market pressures. Market participants are likely influenced by emotions and headlines, such as when uncertainty arises, making this analytical approach essential. The benefits of high free cash flow. In light of multiple headwinds affecting the economy this year, much of the market agrees that the growth sector will be challenged. In the worst-case scenario, we may face a long slog of weak returns in the growth sector. This brings us back to our value discussion, especially for companies with high free cash flow. When a company has a high free cash flow, it can pay dividends, buy back stocks, acquire, expand, and pay its debts. When rates rise, these companies have an advantage because their balance sheets and cash reserves are strong, enabling them to grow even in more expensive conditions. It indicates that a company is operating effectively and committed to achieving sustainable success if it continues to grow free cash flow over time. Despite market pressures, a company that generates a high free cash flow is better equipped to grow long-term while also handling short-term risks such as policy changes and inflation. Meanwhile, companies with low free cash flow and a high price-to-earnings valuation may continue to be more sensitive to rising interest rates and market movements. Typically, but not universally, these are growth companies in the technology industry that have led to long bull markets. Low interest rates have been particularly conducive to the performance of such growth names during the pandemic. As the Federal Reserve signaled more rate increases on the horizon, growth companies with weak cash flow should be cautious. Meanwhile, companies with high free cash flow will become more attractive to investors due to strong fundamentals and their ability to thrive even with rising rates. US markets will likely face inflation fears as they emerge from the COVID-19 pandemic, following countrywide shutdowns and an influx of government stimulus. In 2023, investors must protect their portfolios against headwinds that some may not have experienced before. A company with high free cash flow and a lower price-to-earnings ratio may be a good investment in an environment where price-to-earnings is likely to contract. The limitations of free cash flow. Assume a company has $1 million in earnings before interest, taxes, depreciation, and amortization, or EBITDA, in a given year. At the end of the year, the company purchased new equipment worth $800,000, despite not changing working capital, current assets to current liabilities. To even out the impact on earnings, the expense of the new equipment will be spread out over time through depreciation on the income statement. Nonetheless, as FCF accounts for the current year's cash spend on the equipment, the company will report an FCF of $200,000. That's $1 million EBITDA, $800,000 equipment, on $1 million in EBITDA for dollars that year. Assuming everything else remains the same and no additional equipment purchases occur, EBITDA and FCF will be equal again the next year. If this is the case, investors will have to determine why the FCF decreased so quickly in 1 year only to return to previous levels the following year, and whether or not that trend will continue. Also, understanding the method of depreciation used will help you gain further insights. For example, net income and FCF will differ depending on the depreciation taken per year of the asset's useful life. When an asset is depreciated using book depreciation over a useful life of 10 years, net income will be $80,000 less than FCF for each year until it is fully depreciated. That's $800,000 by 10 years. As an alternative, if the asset is being depreciated using the tax depreciation method, it will be fully depreciated in the year of purchase, resulting in net income equaling FCF in the subsequent year. Now, amidst rising interest rates, here are some things worth considering. Number 1. Identify any existing debts or credit facilities that may be affected by rate increases, such as loans with variable interest rates, and determine how this will affect your monthly expenses. Remember, sometimes your T&Cs can be negotiated, so contact your bank or loan provider if uncertain about them. You may wish to consider paying off your debt early to avoid higher interest rates in the future if you are in a position to. Number 2. Take advantage of creative funding options. If your cash flow is tight, you may want to consider invoice financing, or if you require additional funds immediately, a business line of credit may be an option. It is important to remember, however, that any increase in base interest rates will also increase these repayments if you do not have fixed rates. Number 3. You probably already know this one, but keep an eye on your expenses, reevaluate your budget, and make savings wherever you can. Number 4. The fourth and final tip is to watch your income. As rates rise, consumer spending could dip, and as a result, sales could drop, which will create additional pressure on your business, along with rising material and delivery costs, that is, inflation and borrowing costs. The financial metric free cash flow is extremely important because it reflects the actual cash available at a company's disposal. To remain solvent, a company that consistently has low or negative free cash flow may have to engage in costly funding rounds. Similarly, if a company has sufficient cash flow to maintain its current operations but not sufficient cash flow for growth, that company may eventually fall behind. Finally, yield-oriented investors need to understand FCF to determine the sustainability of a company's dividend payments and the likelihood that a company will raise its dividend in the future. And that is all the time that we have for today, folks. We hope you enjoyed the video. If you did, please hit that like button. If you're new, subscribe to our channel to remain updated about our future videos. We'll see you next time.